Imagine waking up one morning to find that your dream home is no longer within your reach due to a sudden shift in the mortgage market. This is the harsh reality that many Americans are facing today, as debt balances continue to rise and concerns about the state of the mortgage market grow. But here's where it gets interesting. Despite the overall increase in debt, mortgage balances have seen a significant surge, with a $131 billion increase in the second quarter of 2025 alone. To better understand the current landscape of the mortgage market and identify potential risks, let's dive into the latest quarterly report on household debt and credit from the New York Fed's Center for Microeconomic Data. The report reveals that total outstanding mortgage balances in the United States have reached a staggering $12.94 trillion as of June 2025. Loans securitized by government-sponsored enterprises GSEs like Fannie Mae and Freddie Mac dominate the market, accounting for around 52% of all balances, or roughly $6.5 trillion. Government-backed loans, such as those insured by the Federal Housing Administration, FHA, or Department of Veterans Affairs, VA, make up 19% of the total, or $2.5 trillion. FHA loans, designed for first-time and lower-income buyers, comprise 12% of balances, while VA loans, available to U.S. military veterans, account for 8%. Now let's take a closer look at the composition of total mortgage balances by type. The chart below shows that the proportion of different loan types has remained relatively stable since 2019. However, the other loans category, which includes loans held on bank portfolios and private label securitized loans, has seen a significant shift. The more recent cross-section of other loans is overwhelmingly comprised of portfolio loans, particularly jumbo loans that cannot be sold to GSEs. In contrast, the earlier cross-sections of other loans were likely dominated by subprime loans that had been securitized on the private market. But here's the part that might surprise you. Mortgage delinquency rates have risen modestly overall, although they remain low by historical standards. When we break down mortgage balances by their underlying investor types, we notice substantial heterogeneity. FHA loans, in particular, have historically had higher delinquency rates due to their mission to expand homeownership to new buyers. These mortgages have recently seen the steepest rise in delinquency rates, with transitions into 30 days past due exceeding 4% quarterly. This is a significant concern, as it may indicate that FHA borrowers are facing increased financial pressure. And this is the part most people miss: the actual dollar share of mortgages that are delinquent, broken out by mortgage type. Currently, 2.1% of mortgage balances are 30 or more days past due, which is slightly below pre-pandemic levels in 2019. However, FHA loans make up 38% of 30-plus day delinquent balances, despite constituting only 12% of total balances. This disparity is a cause for concern, as it suggests that FHA borrowers may be more vulnerable to default. Now, let's talk about the quality of newly originated mortgages. The good news is that mortgage underwriting standards have remained strict, and average credit scores have remained near historical highs, even during the surge in home buying during the pandemic era. Credit scores at origination for GSE and other loans are the highest of all loan types, with an average of 774. FHA loans, which typically have lower credit scores at origination, are showing average credit scores of new borrowers around 700, near long-term highs. But here's the question on everyone's mind: where are the FHA borrowers? Recent data indicate that a higher proportion of mortgage balances are delinquent in many southern states and Puerto Rico. We also note that a higher proportion of mortgage balances are FHA loans in these regions. Notably, about 20% of mortgage balances in Oklahoma, Mississippi, and Puerto Rico are FHA loans, almost double the national average of 11%. Historically, we see that higher delinquency rates coincide with a higher share of FHA loans across states. So what does this mean for the future of the mortgage market? The picture is very different today than it was in 2008. when a substantial portion of outstanding mortgage balances consisted of non-GSE mortgages that were particularly vulnerable to default. Today's mortgage landscape is marked by more prudent lending practices, and credit quality has improved significantly. The average credit score for mortgages at origination in 2025 was 22 points higher among GSE loans compared to 2008, and FHA loans were 38 points higher. However, there is still some risk that a continued decline in home prices may add pressure, particularly among FHA borrowers. FHA loan products allow for a smaller down payment at origination, which may make borrowers more vulnerable to default if home prices decline. The weakening performance among these borrowers may reflect rising financial pressure amid softening home prices, especially considering the preceding pandemic period of artificially low delinquency rates. Mortgages are a financial tool that has historically helped American households bridge into homeownership and build wealth, and the mortgage market remains the largest and most important credit market for American households. While the recent uptick in mortgage delinquency seems to be concentrated among FHA borrowers, mortgage performance remains very solid when viewed in light of the 20-year history of our data. Still, with the unusual dynamics of home prices in the last 5 years, many eyes are on mortgage performance, and we will continue to monitor this important market. But here's the question we want to hear from you. Do you think the mortgage market is headed for a crisis, or are the current trends just a minor blip on the radar? Share your thoughts in the comments below. And if you're an expert in the field, we'd love to hear your insights on the potential risks and opportunities in the mortgage market. Let's keep the conversation going.